Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice. In the headlines this week, while President Trump continues to generate daily market volatility with his string of headline-making pronouncements, some of which have turned out to have a shelf life of just 24 hours, over here the Saba Capital saga rumbles on. In this episode, I speak to the chairman of another of the 7 trusts that have been under attack from Saba Capital, and his chief investment officer, Bose Weinstein, an American activist hedge fund manager. We finished editing this recording on Wednesday, the 5th of February, and by then we had the results in from 5 of the meetings that Saba Capital has requisitioned. In each of these 5, the boards of the trusts affected have secured clear support from their shareholders to resist Saba's proposals, which are, I remind you, to replace the entire board of directors, appoint 2 new directors nominated by themselves, and potentially then appoint Saba Capital as manager of the trust's assets. Jonathan Simpson-Dent, who joins me now, is the chairman of Edinburgh Worldwide, ticker EWI, whose meeting to vote on the Saba proposals is scheduled for February the 14th. And so I guess the first place to start this conversation, Jonathan, is to get your reaction to the votes that we've had so far. Presumably, you'll find the latest news encouraging.
I do, Jonathan. So 5 of the 7 have now gone. That was CQS and Henderson Opportunities. The 6th one goes tomorrow. We go next week. We're slightly later than the pack, which I'm very happy to talk about later. But no, I find the results encouraging so far on 2 fronts. Firstly, the shareholders have come out to vote. And I think that's just really, really important. In a world where historically retail shareholders in particular have chosen not to vote, AGM turnouts can be as low as 15% in some cases, in our case last year. So voter turnout can be incredibly low. But this time, voter turnout has been very, very strong, for around 60, 70, 80%, including the Saba proportion. So that's really encouraging. The second thing I am very encouraged by is, absent Saba, hardly anyone wants this. So what we've heard from all 5 that have voted so far is very close to 99% of non-Saba voters have said they don't want Saba. So yeah, that is a really, really clear message in my book.
Okay, so as you say, you've got another week or so before your vote comes up, though shareholders do have to get their votes in if they go through platforms early on that, on the 10th of February, isn't it, I think?
Yep,
so
correct.
You don't want people to feel that it's an easy win for you and therefore they shouldn't bother to turn out.
Quite right. This is a really important point, actually. We're going later than the others because there was a technical issue with Saba's original requisition notice. And also, we normally have our AGM about this time. It usually falls in a couple of weeks' time. So we just wanted to bring the 2 together because the last thing we want to do is create more difficulties for shareholders. If shareholders want to attend the AGM as well as the GM, they can now do it on the same day. So for us, it was incredibly important to bring those 2 meetings together. Look, for us, it is vital that people do vote. We've seen very strong votes from the 5 that have gone so far. We wait to see what happens with the 6th tomorrow. We have one of the highest proportions of retail shareholders. Therefore, we are the most exposed to retail shareholders not voting. So we're keeping a particularly close eye on this and trying to be as vocal as possible to make sure our retail shareholders have all the information they need to be able to vote. And that's the story. And also it's the mechanics of how to vote through platforms, etc.
Yes, and we've seen some data coming out of the platforms, the larger ones at least, which suggest that there have been a significant turnout already, and you must be encouraged by that. But this event has not still run the whole course. And also to remind listeners that there are 2 meetings which are having on the 14th of February. One of them is to vote on Saba's proposals, where the board is recommending shareholders vote against, and the other is your normal annual general meeting, or AGM. You, the board, have already put forward some of your own proposals for amending the way that the trust is managed, and they were approved by shareholders at a separate meeting in December. Perhaps you can remind us what it is that you have put forward as your proposal for the future of the trust, and what is at stake at the meeting on the 14th of February.
Yeah, look, first up, you're quite right. There are 2 meetings happening on the same day. So our general meeting will happen first. That is going to follow a very similar format to the other 6 trusts, 5 of which have now gone. So that is a direct poll on the resolutions put forward by Saba, which you outlined at the start of this conversation, Jonathan. The second is our AGM, and that just has a standard normal course agenda. So this is about the appointing the auditors, approving the accounts, about renewing director contracts for the next 12 months. We renew our directors every 12 months, and shareholders, of course, are right to have a say in that. So it is really important that shareholders don't ignore that AGM, because if they don't like the Saba proposals and vote for the GM, and then they don't vote for the AGM, they could still find that the board does not get its renewal for the next 12 months. So that's why we've brought the two meetings together. And then separately, we've put forward quite a detailed program for the medium long term, which we announced last November to shareholders, with a number of changes that we wanted to make to the trust to really re-excite and re-engage and re-enthuse our shareholders about Edinburgh Worldwide, what we're about and how we go about our work. Because, John, the one thing, Weinstein is quite right to point to performance across the sector. Our performance was not where we wanted to be in 2021, back end of 21, 22, 23. He was quite right to point that out. We have taken quite significant corrective action to address that going forward. So that was a separate announcement with some shareholder approvals in November, December.
Okay, so there's quite a bit to unpack here. So why don't we start with how it was that Saba were able to build up a 29.8 or 9 or whatever it is percentage stake in your trust. The performance has been poor. I think we can all say that in terms of underperformance if you measure it over the last 3 years at least, which is what Saba chose to do. And the shares went to a big discount before this all happened. Now, of course, you only took over as chairman last year, so I think you can absolve yourself of responsibility for what happened before that. But when you were appointed chairman, was it with a very clear mandate to do something about the performance that was already poor at that stage? Or was it something that you decided to push forward with once you've been appointed and taken a closer look at what the trust was doing and how it had been acting?
No, look, it was a critical part of the appointment process. In fact, I sat down with the nominations committee before they proposed me to be appointed. And I was quite specific with the members of the nominations committee. Given my background and what I do in my other life outside of Edinburgh Worldwide, I've always been a bit of an advocate for change, for transformation, for growth of businesses. And to scale a business up, you have to be prepared to shake things up a bit and to build a dynamic profile within that business to get ready for growth and to deliver growth. Before taking on this assignment, it was very, very clear that we'd had 2 years of poor performance. And given those 2 years of poor performance, I was very clear with the nominations committee that I was not the stability candidate. If you don't want someone to come in and not rock the boat, that is not me. I believe things need shaking up a bit, and I'm very happy to shake things up, but we'll do it in a thoughtful and well-planned way. So yeah, off the back of 2 years of poor performance, when I took the role on in March, pretty well the first thing I did was really undertake a fully comprehensive review of the previous 2 years, why performance had drifted. We brought in some external advisors to help with that process, because the one thing we didn't want to do is just do that as an internal exercise and just rely on our manager to tell us their views. We wanted some independent views to really validate what had worked, what hadn't worked. And I have to say, one thing I do take exception with Mr. Weinstein on, as he calls us an old boys club, I really take exception of that actually, because I remember my first 6 months in role, I was public enemy number one in Edinburgh with our fund manager. You know, our fund manager were not happy with the work we were undertaking to really do a full drains up review of what had happened with the performance at Edinburgh Worldwide. They knew why we needed to do it, and they agreed that we had to do it. But I have to say, you know, I was the catalyst for that work, and it took a while for them to really sort of come on side. So the thought that we haven't been holding them to account, which Mr. Weinstein says is just a total nonsense. So that work happened. We came up with a series of plans that we announced in November, and it's early days, but I'm delighted to say over the last 5 months, we have seen quite a significant improvement in our NAV. It's up 21% over the last 5 months through to the end of January. But look, I'd be the first to recognize that one swallow does not make a summer. And what our shareholders really wanted to see that continue for the next 2, 3, 5 years. So we've put the changes in place, and I think we're seeing some early fruit from that, but we want to see more.
Right, so you're absolutely right. I mean, the share price, what is around 194.5p, something like that. At its peak, it was 400. Admittedly, it was a pretty exceptional peak, it has to be said. There was that sort of euphoric period in markets. But it's still no higher than it was back in the end of 2019, looking at my share price chart here. So, yeah, it has been very disappointing. Coming from a business background, I think that's one of the interesting things that you've just said, coming in and then looking at how investment trusts operate. Were you surprised that things could get to such a pass? In other words, There are agency issues involved in investment trusts between the fund manager and the board, which wouldn't be the case if you were running an ordinary business. If you were the chairman of the board, you would be able to fire people or replace them or do whatever you wanted fairly quickly. Slightly different with an investment trust because you're dealing with an external contracted partner, aren't you, who historically could have quite a significant impact on the way that the trust is managed.
Yeah, look, I think that's right. But for the avoidance of doubt, our ultimate mandate is to change the manager. If we think the manager is not doing their job properly, we can swap them out and bring someone else in. And that's really important because, again, I think through this campaign since December, I think the waters have got muddied a little between the manager and the board. And again, I think Saba sort of used managers and boards interchangeably a bit. And part of their proposals is actually they want to do the management and they want to appoint the board. We would never be in a position where anyone at Baillie Gifford was allowed to appoint a board member for Edinburgh Worldwide. That is the job of the independent directors to be able to do that. It is a different world, Jonathan. For example, we don't have a chief executive to actually run this campaign. You're speaking to the chairpeople of these trusts because we are the face of these vehicles for shareholders. It is a very different world. It does take time for managers, in our case, to really get the message home that we wanted to change, we had to change. But I just want to put those 2 years of challenge into context. We are actually slightly up over where we were back end of 2019. We then saw this phenomenal spike up to £4 a share, as you just pointed out. And we probably had a higher run up from that based on some of our portfolio. Bear in mind, we were big into the biotech. We had digital medtech businesses that were changing the way service was provided. So they were sort of hot properties during the start of the pandemic. We therefore had further to fall, and we did fall. And at the same time, we had that then compounding factor of the fact that growth investing went out of fashion and the macros were against us and all that sort of stuff. But look, I don't want to sort of excuse 2 years of really difficult performance. I think the key for us was that we took decisive action. Like I said, at the beginning of the process, we had some uncomfortable conversations with our manager, but they absolutely came on board. And by the time we went out to market to announce in November, the mood music had entirely changed. So actually, we can do this better. We have got a better program going forward. We have got a more balanced portfolio that we think is what shareholders really want. So coming out of it, they'd be the first to recognize now with hindsight that that was exactly the right thing to do. And actually, they were really instrumental in a lot of the work. They came right alongside to do that work effectively, along with the external advisors.
But did you ever consider changing the manager? Was that part of the process? Boards, as you say, do regularly change managers, and sometimes they do that without even consulting shareholders. But was that an option that you actually ever considered?
We explored all options, Jonathan. We explored all options, and it was vital for us to do so because ultimately that's what our shareholders expect. Look, shareholders really like the Edinburgh Worldwide mandate. I hear that time and time again, but they want us to perform. They can't just say this is an exciting mandate if it doesn't deliver. So it has to deliver alongside. With that, we had to explore all options. We concluded that we were absolutely committed to staying with Baillie Gifford because at Edinburgh Worldwide, we've got just over a quarter of our portfolio in unlisted investments, unlisted businesses. And actually, investing in unlisted businesses is quite a skill set. And Baillie Gifford have built that skill set over decades, and they do it very well. And actually, trying to find other players in the market with that level of expertise on both the listed side and the unlisted side is quite unusual. So, look, Baillie Gifford do a great job at trawling the globe for an Edinburgh Worldwide type of business, which is something at its early stage that won't have hit radar screens yet. These are businesses before they become household names, very early in their stage of development. And they've got a proven track record of doing that. So that's why we stuck with them. And look, I think the changes we've made will stand us in good stead for the future.
I mean, it's certainly true to say that Baillie Gifford never disguised the approach that they're taking, which is long-term and includes unlisted businesses. And it is often said that the investment trust structure is ideal for patient capital because that way you can have time for your things to mature. But what you seem to be saying is that there's a limit to that. In other words, you can't be patient for a long time if in the meantime you do see significant loss of shareholder value. Am I overinterpreting what you just said?
No, you're not. I think patience lasts so long. We did see some shareholders choose to leave us during those difficult years, which is partly why the discount opened up and partly what opened the door for Saba to come in. So, look, no manager can outperform the market year in, year out over the long haul. There will always be one or two bumps along the way. In our case, our bump was slightly disguised by the fact that growth investing just went out of fashion for a period for all sorts of reasons, not least geopolitical and macroeconomic reasons. So it was out of fashion. But when we saw the sectors that we like to invest in start to pick up in 2023, and Edinburgh Worldwide didn't pick up in 2023, then that was the time for us to take action. The start of 2024, when I came in, it was very clear that we needed to take action, which is what we've done. The world's just moving so quickly, and you'll see this in the work that you do, but the world we live in is changing so quickly, which is partly central to the Edinburgh Worldwide mandate. We like to invest in companies that are going to be the game changers and the drivers of certain sectors in 5-10 years' time. That's what we love, and that's what a lot of our shareholders love about Edinburgh Worldwide. But markets are dynamic, and if we don't respond to changes in market dynamics, then we will not deliver optimal outcomes for shareholders. So for us, it was really important with our manager to have more dynamic learnings and processes to make sure that the portfolio was evolving at a speed that we were all happy with.
You are listening to a Moneymakers podcast. We are an independent research and publishing venture, and grateful to JP Morgan Asset Management for their generous, no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription newsletter, which provides a comprehensive summary of all the latest news, results, and performance data from the investment trust sector, with links to the relevant stock exchange announcements, and many other regular features, including more than 160 in-depth trust profiles, regular market commentary and videos, plus the editor's favorite funds. Never miss a thing that might affect your portfolio. So sign up today at money-makers.co. And thank you for listening. There's another point that troubles me. I should at this point declare that I once was a shareholder in Edinburgh Worldwide, but I haven't been for the last couple of years. Perhaps I should say fortunately, but maybe I should be reconsidering. But if you look at the share count, for example, between 2017 and 2021, which was the period ending with that extremely rapid share price performance, the share count went up from 245 million to 405 million. Significant increase in the share capital, and that came from being able to issue shares at a premium and so on. But it's still at 372 3 years later. So you could argue, and I think I've heard some people argue, that basically what's fit for the goose should be fit for the gander, and that therefore this trust should have been much busier buying back shares, accepting that it's actually constrained by the fact that it has such a significant weighting in private unlisted businesses. So do you see any validity in that criticism? In other words, you can issue shares and you can earn more fees by doing that, but when things go really bad, you don't give the money back, kind of thing.
Well, look, first of all, you're quite right. In 2019, 2020 in particular, we were really in demand, and therefore we were issuing stock at a premium to fill that demand. We have been active in buybacks. We could have been more active in buybacks, but again, back to the work that we undertook last year, we reviewed this and said, what is the right approach for the medium term, which is why we announced a 130 million capital return to be delivered during the course of 2025. And it was very important that we put a sizable number on the table for exactly the reason that you have just mentioned. So we announced that in November. We got shareholder approval to progress with that in December. So that's our immediate plan. We're committed to 130 million capital return for a trust that's around about $750 million. So it's quite a significant part of our program.
Let's talk about then what might happen. Obviously, we don't know what the result of the vote will be. Judging by the other votes, and indeed the fact that shareholders have backed your proposals before, there must be a significant chance that you will see off Saba. But what happens then? Will you be able to get your own proposals through if Saba remain on the share register? And if they do, what else can you do, if you like, to get them off your back? And what sort of priority is that for you, given that I don't think you've had much constructive dialogue with them over the last few months?
We did have some dialogue with them for a good part of 2024, but the dialogue dried up in November and we've had very little dialogue, although I was very pleased that Mr. Weinstein took the time to respond to my second letter that we sent him, just because I felt that he wasn't providing shareholders with enough information to make an informed choice. So he's provided a bit more. There's still a lot of gaps. Look, if I just think about the priorities looking forward, having a large US hedge fund on your share register clearly is an uncomfortable place to be. So that's something that we are absolutely aware of. First priority for me is to keep the turnaround in performance moving forward. That is just so important. Like I said, we've had 5 months since we made the changes, since we announced them back end of last year, of improved performance, and we want to see that continue. The best thing that we can do to make Edinburgh Worldwide exciting for shareholders and get you back in, Jonathan, to be honest, is to show that we are capable of delivering exceptional returns. And we did that in the period from 2014 to 2021, when the mandate actually came about in 2014 through 2021. I want to see a consistent delivery of ongoing performance like we saw in those great years. So priority number 1 is absolutely execute on the changes that we said we were going to execute on back end of last year and see that improvement in performance continue. The second piece we do need to be aware of in the short term is how we now go and execute this 130 million capital return. And of course, we've said that's the quantum of it. You would expect us to explore a number of different ways of achieving that. No matter how the vote goes, if this board is staying in situ in 2 weeks' time when our votes happen and the Saba proposals are rejected, one of the first things that I will be doing is reaching out to all shareholders to really get their views on the future of Edinburgh Worldwide, one of which will be Saba. So I'm hoping to have a very constructive and open dialogue with them, subject to that particular outcome. I think you're touching on a longer term issue, and you are very familiar with the investment trust sector. The investment trust sector needs to be capable of exciting people for the medium long term. What we can't be in is just an ever-shrinking world where people are redeploying their money into wealth managers who deploy it into ETFs, etc. And people just lose heart and excitement in the investment trust sector. We absolutely need to generate that long-term excitement. And at Edinburgh Worldwide, we do it through 2 ways. Firstly, getting people really excited about the mandate, showing that it is different to what they can get elsewhere in the market, a chance to partake in businesses like PsiQuantum that you just can't buy in the open market, these game changers for tomorrow. But secondly, we need to sort of craft a longer term story for shareholders that makes them feel that they're never going to feel trapped in a product like Edinburgh Worldwide. And what that means for ongoing discount management, what it means for ongoing capital returns, we'll get to later. But I think as a sector, we need to get our minds around this. We can't just stay in the old world when actually market dynamics are saying something different.
Right. So obviously the discount has come in quite significantly, but of course there are concerns that it may then widen again once this whole drama is over. Some of your shareholders may have sold out and others may not. In terms of specific plans for doing that, do you have a specific target in mind? Should trusts like Edinburgh Worldwide ever trade at more than a double-digit discount, for example, apart from an exceptional market crisis, would you think that's a fair direction of travel?
I hear different views on discounts. There's been 1 or 2 commentators saying if the discount is steady over time and it's always at just, let's call it 10%, if it's always at 10% and shareholders know it's always going to be at 10%, then that's not a problem because they can trade in and out and they'll get the NAV appreciation over time. We've then got a slightly different issue in a portfolio like Edinburgh Worldwide because we are slightly over a quarter of the portfolio in unlisteds. And in my other world of private businesses, usually there is an element of discount for illiquid assets over liquid assets. That's just the way of the world. So I would expect in normal course a portfolio like Edinburgh Worldwide with circa 25% in unlisteds to trade at a slightly bigger discount to the market. And what that means, the market will sort of tell over time, but does that mean a high single digit, a low double digit discount? I think where it becomes a particular problem, Jonathan, is where you've got a very widely fluctuating discount. And look, these things always go in cycles, but when discounts get up into the high teens, 20%, then people start to get uncomfortable. And again, back to long-term solutions, I think the sector and boards like our board need to figure out 3-5-year strategies for how we handle those particular situations. And like I said, there will be certain times where you get a short-term opening up or closing of the discount or a small premium for whatever reason. If that's a short-term thing for a few quarters or 3 or 4 quarters, then that's one thing. But the one thing we don't want to see is the opening up of a significant discount that then sticks around for a long time, because that just tells us that we haven't got a product that people are excited enough about.
Indeed. And one question, I guess, which I have to ask you is, I asked you whether you thought about changing the manager. The lead portfolio manager at the moment is coming for some personal stick from Mr. Weinstein. And obviously, as Mr. Weinstein's pointed out, there have been significant outflows from his open-ended fund as well. Do you think that you have got the right personnel in place?
Well, again, it was quite a big part of our program last year when we did the full review. We looked at the team with Bailey Gifford. We had some very open conversations with them. We think Douglas Brody is a very talented individual. He's got a long track record of successful investment. He is really strong in the biotech, medtech sector. And yeah, that's one of the three largest sectors that Edinburgh Worldwide invests in. But we wanted a more rounded team. So we didn't want to throw the baby out with the bathwater because we think Douglas is quality. But at the same time, we wanted to bring some of the up-and-coming talent to have an equal share of the voice in portfolio construction and some of the other sectors, which is why we've got now 3 co-managers running this, all with different sector-specific skills, some with very specific skills on the unlisted side of the house. So by putting this management structure in place, we believe we've got a really blended team that can manage the portfolio, the overall portfolio better going forward.
And in terms of the mandate, the global smaller companies sector is quite a small one in the investment trust world. And you are distinctive, obviously, by virtue of the private holdings that you have. But you still think there is, or at least it's your job to persuade people that there is a future for a mandate of that sort, regardless of who it's managed by.
Look, if I didn't believe...
Global smaller companies are not small companies, of course, in most people's view of the world. But
I know, I look at some of the constituents of the S&P small cap and staggered by the size of some of these businesses, and that has changed over time. Jonathan, to answer your question, if I did not believe that this mandate had relevance to shareholders, then we would have concluded very differently last year and taken Edinburgh Worldwide down a different route. We concluded categorically that we think this is an exciting mandate and we think that it is a unique mandate. Again, we are exclusively focused on trying to find those hidden gems that are going to shape the future. And that's what Edinburgh Worldwide offers. It offers shareholders a chance to buy into that future, a little window into that future. That's what we're about. And we don't see anyone else doing that in the way that Edinburgh Worldwide does it. We have to be relevant. If we're not relevant and differentiated, then we'll take this down a different route. But we firmly believe that we are. And now we need to demonstrate consistently that that can also generate strong returns for shareholders, as well as excitement about owning wonderful businesses like SpaceX and some of the others in our portfolio.
yes, of course. And I guess my question was really directed to this idea of whether or not it actually is mixing public listed equities and private, as it actually is a good idea when perhaps you could do the two separately. Why mix them up and cause a bit of confusion? And also some volatility, I think, inevitably happens as a result of that. But you think that should continue in the 30% roughly, isn't it, in your case, I think? You're happy with that? You want to keep that?
Yeah, definitely. And look, Edinburgh Worldwide is about the ideas, the ideas for the future. And in some cases, some of these businesses are listed. In some cases, they're not listed. We're 25-75, unlisted to listed. By having a 25-75 mandate, we can go and find the best companies that we think are delivering that game-changing potential for the future. Some of them are listed, many of them are unlisted. So if you believe in the mandate and you do want that piece of the future state, then you almost have to have a bit of a blend between listeds and unlisteds. So I think it's a very, very important part of the Edinburgh Worldwide portfolio and our story and our skill set.
So just suppose SpaceX does do an IPO or comes to the market, would you be looking to keep the same percentage after that? Be looking for the next SpaceX? Is that how it would work?
I think we always have to be very cognizant of overall portfolio balance and equilibrium. SpaceX has been a great investment for us so far. It is now our single largest holdings, about 12% of the portfolio. We're delighted to be in there. We trimmed our position in SpaceX in Q4 last year. We trimmed it because we didn't want it to become high teens in terms of our portfolio mix. I don't think shareholders would thank us for an imbalanced portfolio that was very dependent on one single business. So look, who knows where SpaceX will go and whether it IPOs in the future, but not specific to SpaceX, but across our portfolio, we're always looking for that balance. We're always looking for the right opportunity to get into positions and out of positions. So that's very much part of our mantra.
And you mentioned that you have a higher proportion of retail investors than most of the other trusts involved in this saga. Is that something that you welcome or you want to see grow? One of the points I've heard is that obviously this whole exercise of defending yourself against Saba has cost shareholders quite a lot of money. But the positive side is you've managed to reach private investors who you haven't communicated with for a while, as you say, for 50% turnout at AGM and so on. Do you actually think that having a largely predominant retail investor base is something you should be looking for and aiming to enhance? Or is it actually something that creates some problems of its own?
I'm very happy with the large retail shareholder base. About 45% of our shareholders are retail shareholders who hold through the platforms. We've got another about 20% through wealth managers. I'm very happy with that. It's very, very Edinburgh Worldwide. Back to that unique mandate. That unique mandate excites a certain type of investor and a certain style of investor. And we'd hope that there's always room in someone's individual portfolio, yourself included, for a mandate like Edinburgh Worldwide. It is a very specific mandate that appeals to retail shareholders. I think what Mr. Weinstein's done, and this is no bad thing, by the way, I think he has made all of us up our game in terms of how we communicate and engage with investors. He's really put shareholder democracy on the table. He's really put how the platforms engage with their retail shareholders, how boards engage with retail shareholders. So look, I am thrilled with the last couple of months to see the extensiveness of the interest in the sector and the level of engagement from retail shareholders with boards and with managers. So I think that's a really positive thing to come out of this, and long may that continue. And so long as we've got that direct and dynamic dialogue with retail investors, I don't see any harm in an investment trust like Edinburgh Worldwide being highly appealing to retail shareholders.
Just finally on that point, I don't want to belabor it, but obviously, as I said, there's a lot of costs incurred. Should those costs be borne by the shareholders or should they be borne by the fund management company? How do you divide that up? I know it varies from trust to trust, but if you're going to remain committed to an active communication program, which I imagine you are following this, how should that be resolved? Who's basically should be paying for that?
In the case of Edinburgh Worldwide, we've got a very simple formula that is split 50-50 between the company and the manager. And again, we think that that simple formula works very well. Not all shareholder engagement needs to cost extortionate amounts of money. As part of this, we've set up a new website, trustewit.com, and that is allowing us to get extra materials out direct to shareholders for shareholders to access anytime they want to. So they can hear from myself, the board, the manager, just what's going on in the portfolio, so they get much more color about what Edinburgh Worldwide is. We don't want it to be a mystique. We don't want it to be that sort of mystery. So separate issue, from time to time, you need to invest additional monies. We invested additional monies last year when we went through the comprehensive review of performance. We had to learn to make sure that we were making the right changes to move forward. And look, following a period of difficult performance, I was delighted that our manager actually dropped their fees for last year, which allowed us to help fund some of that work, which was great. The board as well has kept our directors' fees flat because, until we're back in an environment where we feel shareholders are benefiting consistently for this, we just felt it was appropriate to do. So from time to time, extra investment does need to be made. This Saba campaign across all 7 trusts has incurred quite significant cost, and I'm sure the other 6 chairs would say the same. But look, we think it's for the right reason. We think that this is about shareholder choice and shareholder democracy and access to mandates like Edinburgh Worldwide, which is why we're fighting for it.
Yes, and if they don't vote, then of course that tells its own story. So it's very encouraging to see that happen. On a personal note, I wonder if you realised quite what you were letting yourself in for when you took this on. You sort of implied that you did. You know that Saba has obviously stakes in another dozen or so trusts. Are you up for doing another one?
Look, I'm fully committed to Edinburgh Worldwide at the moment, and we've got an exciting journey ahead of us, and I don't want to dilute that. I love talking to my fellow chairs. We share ideas a lot, and I love doing that. My diary is pretty full with the other 3 businesses that I look after, so I'm going to reserve judgment on that until I've got a bit more time on my hands.
Very good. So that was Jonathan Simpson-Dent, the chair of Edinburgh Worldwide, ticker EWI, talking to me just ahead of the critical vote that's coming up on Saba's proposals and will determine the future of the trust from here.
Thanks very much, Jonathan. Thanks for having me, and I look forward to getting our shareholders to vote for us in the next few days.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. Please note that podcasts are provided for educational purposes only, and nothing you have heard from any speaker should be regarded as constituting investment advice. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.